If you step back for a moment and look at what's happening right now, the picture gets uncomfortable very quickly. At this exact point in time, the same ounce of silver carries 3 different price tags depending on where you're standing. In New York, it's trading around $78. In London, closer to $76.50. In Shanghai, it closed just under $75. Same metal, same day, same global market, yet a $3 gap. In a world where prices are supposed to converge instantly, that kind of divergence isn't noise, it's a signal. And it's a signal most people are being encouraged to ignore. What makes it more interesting is what's happening quietly behind the scenes. Over the past 3 months, JP Chase has moved roughly 4.7 million ounces of physical silver into Chinese vaults. Goldman Sachs added another 3.1 million ounces. HSBC shifted close to 2.8 million. These aren't paper trades or clever accounting tricks. These are real bars, tracked through exchange filings and vault receipts. The big banks aren't speculating on a screen. They're relocating metal. And they're not doing it because silver happens to be a few dollars cheaper in Asia. They are redoing it because China is one of the last places where you can still take large-scale physical delivery without blowing up the system. That price gap you're seeing isn't an inefficiency or a gift-wrapped arbitrage opportunity. It's a warning light on the dashboard. Historically, gaps like this show up right before something breaks. And if you've studied enough monetary history, you start to recognize the pattern. Every fiat currency system that has ever failed followed the same sequence. Different centuries, different empires, same storyline. Ancient Rome, Song Dynasty China, Revolutionary America, Weimar Germany, Zimbabwe, Venezuela. The names change, the outcomes don't. There are 4 stages, always in the same order, and right now we're deep into stage 3 and picking up speed. The unsettling part is that this time it's not some regional currency on the edge of the world. It's the global reserve currency. When that one snaps, it doesn't fall quietly. It takes a lot of furniture with it. The banks understand this. That's why they're moving metal now, not later. And you don't need conspiracy theories to explain it. You just need history, math, and a little honesty about human behavior. Every cycle begins the same way. A currency is introduced and anchored to something real. It could be gold, silver, land, or productive output. The specific anchor doesn't matter as much as the principle. The currency represents a claim on real value. You can exchange paper for something tangible. That constraint builds trust, and trust is the entire game. Rome's denarius was almost pure silver for centuries. You could weigh it, test it, and use it across the empire. The United States did the same thing for much of its early history. A dollar was a claim on gold at a fixed price. During this phase, inflation stays low, prices make sense, and governments are forced to behave because they can't print their way out of bad decisions. Then comes temptation. Governments discover that they can issue more currency than they have backing. At first, it's modest, a little extra to fund a war, a bit more to build infrastructure or expand social programs without raising taxes. It feels painless, almost generous. But what's really happening is that trust is being borrowed from the future. Rome's Emperor Nero reduced the silver content of the denarius slightly, from 95% to 85%. Most people didn't notice. Prices edged up, but life went on. So the process continued. By the 3rd century, the silver content had collapsed to almost nothing. The United States followed the same trajectory in modern form. When the gold window closed in 1971, the dollar became pure fiat overnight. Since then, the money supply has exploded. What was hundreds of billions became tens of trillions. The system still functioned, which is why most people stayed calm. But beneath the surface, the ratio of currency to real assets was deteriorating. Eventually, the pace accelerates. Debts pile up. Obligations become unmanageable. Printing turns from a choice into a necessity. This is where trust starts to leak out of the system. Prices don't just rise yearly, they rise monthly, then weekly. People notice that their savings buy less and less. They don't need an economics degree to feel it. Instinctively, they look for safety in things that can't be created out of thin air. Metals, land, commodities, anything solid. Governments respond the only way they know how. Controls, regulations, reassurances. Official statements insist everything is stable. History shows they are usually delivered right before stability disappears. When this phase sets in, strange gaps appear. Official prices diverge from real prices. In Rome, price controls were enforced with brutal penalties, yet black markets flourished anyway. In Song Dynasty China, the government outlawed the use of metal money, forcing paper notes on the population. The punishment for disobedience was severe, but silver still traded underground at multiples of the official rate. In Weimar Germany, gold and foreign currency were illegal to hold, yet everyone knew the real exchange rates, and they were wildly different from what the government published. These gaps aren't malfunctions. They're honesty leaks. They reveal that the official system is no longer telling the truth. Today, we're watching the same thing happen in real time. Silver trades higher in Western paper markets than in Eastern physical ones. Gold shows similar stress. On futures exchanges, you can buy endless paper contracts at spot prices. Try converting those contracts into actual bars, though, and suddenly there are delays, restrictions, and premiums. Physical silver routinely trades 8 to 15% above paper prices. American Silver Eagles selling near $90 when spot is $78 isn't normal. It's a message. Paper promises and real metal are no longer equivalent. As these spreads widen, the system edges closer to the final act. At that point, the currency doesn't gradually fade, it fails outright. People refuse it. Shops close rather than accept worthless money. Trade reverts to barter or hard assets. Wealth doesn't disappear, it transfers violently. In Rome, the denarius vanished within a few generations, and the empire followed. Those who had shifted into gold, silver, and land early survived and shaped the next system. The middle class, loyal to the currency until the end, was wiped out. In Germany, 1 trillion old marks became one new unit overnight. Lifetimes of savings evaporated. Those holding hard assets walked through the chaos intact and often emerged stronger. Now apply that same framework to the present. The dollar became the global reserve currency in 1944, backed by gold. That trust lasted until 1971. Since then, expansion has been relentless. The Federal Reserve's balance sheet has ballooned through crises and emergencies, each one justifying more creation of money. The result is a dollar that has lost the vast majority of its value against real assets. Gold has risen 70-plus times since the early 70s. Silver tells an even stranger story. Despite its essential industrial role, it remains undervalued relative to gold, largely because of massive paper leverage. The futures market trades hundreds of ounces on paper for every ounce that actually exists. The entire structure assumes that most participants will never ask for delivery. That assumption is starting to crack. Physical supply is tightening. Industrial demand keeps growing, driven by solar, electric vehicles, and technology. Investment demand is picking up. Inventories are shrinking. Paper markets are showing stress through higher margins and delivery delays. Meanwhile, the biggest financial institutions aren't arguing on television. They're quietly moving metal. That's where we are. Not at the beginning of the story, and not at the end yet. But in that uncomfortable middle where signals are flashing and most people are still being told everything is fine. History doesn't repeat perfectly, but it rhymes closely enough to be recognizable. When the gaps appear, when physical matters more than promises, and when those with the most information start acting differently than they speak, it's usually a sign that the clock is ticking. Before most people notice a crisis, the market usually whispers it first. Right now, silver isn't whispering anymore. It's clearing its throat loudly and tapping the microphone. When private mints are charging 12% over spot, that's not a quirky supply hiccup. When even 1,000-ounce commercial bars, the kind that are supposed to trade closest to spot price, are commanding 5 to 7% premiums, something is off. That simply does not happen in a normal, well-functioning market. Ever. This is the kind of distortion you only see when the system underneath is under real strain. Then there's the geographic arbitrage, which might sound boring, but is actually one of the loudest alarms right now. The price spread between Shanghai and New York isn't a tidy little gap. Today it's around $3. 3 weeks ago, it was $5. 2 months back, it briefly spiked to $7 before pulling in again. That volatility tells you everything you need to know. Physical metal is flowing east. Not paper promises, not contracts, not accounting entries. Real bars are leaving Western vaults and heading to Asia to meet delivery demands. This isn't retail investors doing something quirky. This is the biggest banks on the planet repositioning. JP Morgan, Goldman Sachs, HSBC, Morgan Stanley, they're all moving metal. And let's be clear, they're not doing this because they suddenly woke up and decided silver is a great long-term investment. They've always had access to silver. They're moving it because they need it where delivery pressure is highest. They're moving it because they understand the Western paper system is wildly overleveraged. And they're moving it because they're preparing for what comes next. This is where it stops being just about silver. Silver is the canary in the coal mine. The real story is the dollar and, more broadly, the fiat currency system itself. The dollar's global reserve status has always rested on trust. For decades, the world accepted dollars because the United States was the dominant economy, had the strongest military, and projected political stability. That trust is eroding faster than most people realize. Look at what's already happening. The BRICS nations are actively building alternatives to dollar-based trade. China and Brazil now settle trade in yuan. Saudi Arabia is accepting yuan for oil. Russia and India are settling in rubles and rupees. Meanwhile, the dollar AS share of global central bank reserves has fallen from 71% in 1999 to about 58% today. That's not a rounding error. That's a structural shift. Here's where silver comes back into the picture. When confidence in fiat currencies fades, capital doesn't just disappear. It runs. It runs into hard assets. Gold has always been the primary monetary metal, the anchor. But silver plays a different role. It's the pressure relief valve. It's accessible, affordable, and practical. Historically, when currency systems crack, silver becomes the money of the people, while gold becomes the money of governments and the very wealthy. The banks understand this dynamic better than anyone. They're not just satisfying delivery demands in China. They're positioning for a world where physical precious metals matter again, where paper promises break down, and where counterparty risk isn't theoretical but existential. If you own a silver ETF right now, you own a claim on silver held by a custodian bank that has likely rehypothecated that same silver to multiple parties. If everyone asks for delivery at once, it simply isn't there. The banks that hold physical silver in allocated storage don't have that problem. They hold the asset, not the promise. This is stage 3 behavior. Smart money exits paper and moves into physical. Geographic spreads widen, premiums explode. Delivery delays become routine, and governments start to respond not calmly but forcefully. In January 2024, the CFTC proposed new limits on silver futures positions, claiming it was about preventing manipulation. The obvious question is, manipulation by whom? The people demanding delivery, or the banks that are short hundreds of times more silver than actually exists? By March 2024, the U.S. Treasury added silver to its list of critical minerals and began discussing strategic reserves. That's not random. Silver is essential for national security, technology, and energy infrastructure, and officials are realizing the market is tight. In June 2025, the EU went a step further, requiring precious metal ETFs to be physically backed. Synthetic exposure and swaps no longer cut it. Now those paper claims have to be matched with real metal, and there simply isn't enough to go around. These are all stage 3 responses. Governments trying to control a crisis they helped create, hoping to delay the transition to stage 4. History says that never works. Rome tried. China tried. Germany tried. Every time, the outcome was the same. At this point, most people mentally reach for one of 3 comforting arguments. The first is that the dollar is different. It's the global reserve currency, backed by the strongest economy and military in history. It can't fail. That belief is as old as empires themselves. Rome thought the same thing. So did Song Dynasty China. So did Britain when the pound sterling ruled global trade. Empires don't collapse because they're weak. They collapse because they overextend, debase their currency, and fund obligations they can no longer afford. The United States today fits that pattern uncomfortably well. 900 military bases across 80 countries. Defense spending greater than the next 10 nations combined. $34 trillion in federal debt and roughly $185 trillion in unfunded liabilities. $2 trillion deficits during peacetime and full employment. Reserve currency status doesn't prevent collapse. It amplifies the consequences when it happens. The second argument is that technology will save us. Digital currencies, blockchains, central bank digital currencies. A shiny new system. Technology changes the wrapper, not the math. A failing currency on a blockchain is still a failing currency, just with better tracking. In fact, CBDCs likely accelerate the endgame. They enable instant control, instant debasement, account freezes, negative rates, and programmable money that can expire. Cash can be hidden, gold can be buried. A CBDC offers zero privacy and total control. When people realize that, the flight into non-digital, non-confiscatable assets accelerates. The third argument is that the government won't let it happen. Rates will be raised, spending will be cut, the problem will be fixed. The numbers say otherwise. With $34 trillion in debt at an average interest rate of about 3.4%, annual interest payments already exceed $1 trillion. Raise rates to 5%, and interest jumps to $1.7 trillion. Push them to 7%, and interest hits $2.4 trillion, nearly half of total federal tax revenue. They can't raise rates without bankrupting the government, and they can't keep rates low without stoking inflation. They're trapped. There are only 2 real exits: default, explicitly or implicitly, both of which destroy the currency, or massive austerity, which is political suicide. So they'll choose the path of least resistance. They'll print. They always do. Government intervention isn't proof the system is healthy. It's proof the system is already breaking. Healthy systems don't need emergency measures. Every historical example ends the same way because the math doesn't change. So what do you actually do? First, understand the timing. We're late in stage 3. That means there's still a window, but it's not measured in years. The shift to stage 4 is often sudden, triggered by a bank failure, a sovereign debt crisis, or a geopolitical shock. When it starts, it moves fast. Second, get physical. This part isn't optional. Not ETFs, not paper. Physical metal you control or store in allocated non-bank storage. Paper and physical are already diverging. When stage 4 hits, that gap becomes a chasm. Third, pay attention to the gold to silver ratio. At roughly 34 to 1, it's historically stretched. In past monetary crises, that ratio compresses sharply. Even modest normalization implies dramatic upside for silver. Fourth, diversify into other hard assets. Precious metals are core, but productive land, energy, infrastructure, and real commodities matter too. Wealth doesn't sit still in a currency crisis. It rushes. Finally, keep some liquidity. Don't trap yourself. Flexibility matters when systems are stressed. Silver isn't the story by itself. It's the signal. And right now, the signal is getting very loud. If you strip away the noise and the daily price tickers, what this really comes down to is positioning yourself so you are not forced to make desperate decisions later. That's the mistake people always make in currency crises. They wait until the headlines are screaming, and by then, every door is already half closed. A smarter approach is boring, almost unexciting. Keep a meaningful slice of your net worth liquid. Not all of it, not even most of it, but enough. Think 10 to 20%. Enough to cover 6 months of living expenses, enough to stay calm when others are panicking, enough to take advantage of opportunities that only show up during chaos. Because when the system tips into the final phase, there is a short but very real window where cash suddenly becomes precious again. Everyone scrambles for liquidity at the same time. Assets that were long-term holds get dumped at fire sale prices. Businesses, properties, metals, productive assets, sold not because they're bad, but because their owners need cash now. If you're sitting on liquidity during that moment, you're not guessing, you're shopping. And once those purchases are made, you don't cling to the currency, you rotate straight into hard assets before confidence in the money evaporates entirely. That's not theory. That's how wealth quietly survives currency transitions. Liquidity first to survive and buy the panic, then conversion into real assets before the currency finishes its collapse. Right alongside that is something that sounds backwards to a lot of people: reducing debt. You'll often hear that inflation is great for debt because you pay it back with cheaper money. That idea only works in clean, controlled inflation where incomes rise along with prices. Late-stage fiat breakdown is messier. Real wages fall, jobs disappear, businesses shut their doors. Income doesn't keep up, it vanishes. If you're carrying debt in that environment, you're cornered. You're forced to sell assets just to keep servicing loans, usually at the worst possible moment. So the unglamorous advice is the right advice. Get out of debt. Sell what you must. Downsize if necessary. Simplify your life. Financial flexibility isn't a luxury in the final stages. It's survival. Then there's the part everyone would rather skip, but history doesn't let us. Currency collapse almost never stays confined to spreadsheets and balance sheets. It spills into society. Trust weakens. System strain. Services become unreliable. We've seen this movie before. In Weimar Germany, hyperinflation didn't just destroy savings, it destabilized politics. Millions of people gravitated toward extremes immediately after the currency failed, and within a decade the country was unrecognizable. That wasn't an anomaly, it's a pattern. When money stops working, social order gets tested. That doesn't mean the world ends. It means priorities change fast. Food security matters more than convenience. Energy security matters more than comfort. Personal security matters more than ideology. Supply chains break, sometimes briefly, sometimes for years. Civil order stretches thin. Having a plan, a network, and essential supplies isn't paranoia. It's pattern recognition. Every stage 4 collapse in history has included a period of social stress. The timeline varies, but the stress never skips the script. This is why what's happening in the metals market matters far beyond price charts. When major banks quietly move physical silver eastward, especially into China, they're not chasing a short-term trade. They're responding to the same historical math you're now looking at. They see stage 3 accelerating. They see the system's promises growing mathematically impossible to keep. They see arbitrage gaps widening, not narrowing. And they're positioning physical assets where they believe delivery, safety, and value will be more reliable. That price difference you're re-seeing, silver trading higher in New York than in Shanghai, isn't a glitch or a pricing mistake. It's a stress signal. It's the market admitting, in its own blunt way, that physical silver is leaving the West because Western financial institutions can't guarantee delivery at scale. It's a quiet confession that the paper market is cracking, that the fractional reserve system for precious metals is failing. Silver just happens to be the canary. This pattern doesn't stop with silver. It rolls into gold, then other commodities, and eventually the currency itself comes under pressure. And that's the part people misunderstand. This isn't about national strength or weakness. It's not about politics or patriotism. It's about mathematics. Stage 3 always leads to stage 4, always. Rome couldn't stop it. Imperial China couldn't stop it. Britain couldn't stop it. Germany couldn't stop it. The United States won't stop it. You can't override economic laws with military power or political speeches. You can print currency, but you can't print wealth. When the gap between the two becomes impossible to ignore, trust collapses and the system resets. You can see that gap widening in real time if you're willing to look. Compare spot prices to physical dealer premiums. Compare futures prices to what it costs to buy actual coins and bars. Compare New York pricing to Shanghai. Compare paper ETFs to the premiums on real metal you can hold. The discrepancies are measurable and they're growing. That's not sentiment, that's data. Then zoom out and look at the bigger numbers. Federal debt north of $34 trillion. Annual tax revenue under $5 trillion. Unfunded liabilities stacked far beyond that. An expanding balance sheet. A bloated money supply. The math doesn't balance. And it never will. History tells us exactly how this ends, not because history is poetic, but because fiat currencies all share the same flaw. Every single one ever created has eventually failed. Not most of them. All of them? The average lifespan is about 27 years. The dollar has been pure fiat for over half a century. We're not special. We're not immune. We're just further along the curve. So the real question isn't whether this transition happens, it's where you're standing when it does. Do you want to be positioned like wealthy Romans who held gold as the denarius collapsed? Or like the middle class who trusted paper until it was worthless? Like Chinese families who converted to silver before their currency failed? Or those who believed official reassurances? Like Germans who bought gold in 1921? Or those who held marks until 1923? The difference wasn't intelligence. It was timing and positioning. The banks have already answered that question for themselves. They're moving physical metal now. They're not waiting for headlines or official announcements. They're acting on patterns that have never failed. That silver price gap isn't about squeezing an extra few dollars of profit. It's about survival. The price divergence is the signal. The physical movement is the confirmation. History is the proof. If you want to understand this at a deeper level, don't take anyone's word for it. Pull the data yourself. Compare markets. Study the balance sheets. Read the history. Then decide how you want to be positioned. Because once stage 4 starts, it doesn't give you time to catch up. Preparation only works before the break, not after. If this analysis clarified what's unfolding, the next step is action, not procrastination. Learn which forms of silver actually make sense, which dealers can deliver, how to store physical assets outside the banking system, and how to structure a portfolio for transition rather than collapse. Time is the one asset you can't buy back. And in stage 3, time is running out. Position while physical metal is still available, while premiums still make sense, while the system still mostly functions. Because when the final phase begins, it moves fast. And at that point, preparation is no longer possible. You can only live through what you saw coming. The pattern has never failed, and it won't start failing now.